Hello and welcome back, guys. So basically we will be discussing about IFRS 16 leases, right, in this particular chapter. And then what we will be looking at is that, so what is a lease? Okay, so a lease is a contract. I'll just move this thing as well so that it's easier. Okay, so what is a lease, right? So a lease is a contract or part of a contract. Okay, it's a contract or part of a contract which basically provides a right of use assets of an underlying asset to a lessee. Okay, so for a period of time in exchange for consideration. So who's a lessor? A lessor is an entity which provides the right of use assets, in exchange receives consideration. Okay, so a lessee is who obtains the right of use assets in exchange for consideration. Okay, so the other thing is, what is right of use assets? So the right of use assets is the lessee's right to use an underlying asset for a period of time. Okay, so for a certain period of time. That is our standard definition as per IFRS 16. Okay. Similarly, so what is a contract? So a contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Okay. So so basically what should the contract contain is that it should provide a right to control and identify assets for a period of time in exchange for consideration. There should be some consideration. Okay, even though it's just 1 rupees or whatever that is, there should be a consideration. So when does the customer have the control of the asset? So the customer generally has the control of the asset if it can basically prevent others from getting substantial benefit out of it, or if it can direct the identified assets use. Okay, so it could be in any form, like basically it's not the scope, but still it can still direct the use of it. Okay, that is very crucial. So these are the things that we need to consider. Next thing is, basically the right to direct the use of an asset can still exist if the lessor puts restriction on the use on its use within the contract. Okay, so there could be a restriction on the underlying asset as well, but such as, like, let's say you are not allowed to put explosives inside your house, you are not allowed to carry harmful chemicals, right? So because that's just, they are just limiting, they are just putting the restrictions on his use. So it is just they are just trying to minimize the scope of it. Okay, so still, even though still they restrict the use within that contract, it still is basically the lessee still has the right to direct its use, right? At the end of the day, they can direct its use, right? So a customer does not have the right to use an identified asset if the supplier has practical ability to substitute the asset for an alternative if the switching cost is minimal. Okay, so the customer also does not have the right of use assets if the lessor can basically substitute the asset, okay, for an alternative, and the switching cost is very low, and it won't act as a disincentive so that for the people will switch, right? So in this case, it's just a incentive, right? So in case of IFRS 16, when we are measuring leases, so it's always measured at present value of the lease payments in terms of initial measurement, and then the lease liability or the lease payments includes the following. Okay, so it includes fixed payments, variable payments, which could be based on index or something else, and then amount expected to be paid in form of residual guarantee. Other thing that could be is that if you have an option to purchase the asset, and if it is certainly likely that the likely that we will exercise it, then that is also included. And termination penalties. So if the lease term reflects the expectation that these will be incurred, so many people don't understand this particular line. So it just means that, so if the lease term is, let's say, 5 years, right? So our plan in the head is that, like, we will only be contracting or renting it for like 3.5 years. So you're more likely to incur that penalties, right? So that should be also included in the present value, like in the present value in within your lease liability. Okay, that's all it basically means. Next thing is, let's talk about right of use assets. So on your left hand side, you will be recognizing lease liability. On the right hand side, you will be recognizing right of use assets, right? So whenever you are recognizing right of use assets, it's always measured at cost, and then there is another cost that we need to include as well. So any direct cost associated with that particular lease, or the lease payment which is made at or before the commencement date, will also be included, and the initial measurement containing all that thing that we discussed earlier, like all these things, will also be included. Okay, all these things will also be included. So last thing that will also be included is that the estimated cost of dismantling cost, or removing the assets from that particular site, will be also included, like in case of IS 16, right? So similarly, the lease term, what will the lease term comprise is basically the non-cancelable period, and then the period covered by an option to extend the lease if it is certain to be exercised. And other thing, it could be that the period covered by an option to terminate the lease if reasonably certain not to be exercised. Okay, so if you are certain that the lease won't be terminated after 5 years, let's say we will be renting it for 7 8 years, right? So you are not reasonably certain, right, that it won't be exercised, so that will also be included. Okay, so even though the lease term is only 5 years, you will also have to include the other period as well. Okay, so whenever we are talking about subsequent measurement, its basic treatment will be, in case of lease liability, what we will be basically doing is that we will be increasing the interest charge, and the interest will be recorded in SOPL as finance cost, right? So debit finance cost, credit lease liability, increase your liability by, because of time value, right? So in case of right of use assets, what we need to do is that, so basically, if it is measured using cost model, what we need to do is that it will always be depreciated. Okay, so the carrying amount of right of use assets will be initial cost minus accumulated depreciation minus accumulated impairment loss as well. Okay, so it should be impairment tested as well. So how will we treat depreciation in this particular case is that, so it will always be the shorter of, okay, so it will be shorter of the useful life or the lease term. So if the ownership of the asset is transferred to the lessee at the end of the period, then the depreciation would be charged over the asset's remaining useful life, right? So if it is not transferred, right, if it's not a finance lease, then what we need to do is that, basically, shorter of the useful life of the asset, and then the lease term. Okay, so whichever is shorter of these two things, we will need to take that into account. So next thing we need to be talking about is separating components. So this will be basically like componentization that we talk in case of aircrafts and all, right? So but in this case, what we are talking about is that the lease component and then non-lease component. Okay, so every year you have to do a repair, and then what we'll do is that, basically, we will treat those expenses separately. Okay, so it's a bit different, a little bit different, but the lease component treatment will be same. The non-lease component won't be discounted to present value. Okay, that's the only main difference in this. So what does the second number bullet point say is that, So unless an entity chooses otherwise, consideration is allocated to each component based on the standalone selling price. Okay. So we have an example as well. So it should be allocated based on their standalone selling price, like we used to do in case of revenue and all as well, right? So proportionate of the standalone selling price. So basically that same thing will be used over here as well. So the entity could use the lease and non-lease component as single lease, right? So but what this will do is that it will basically hamper the perception of investor. How, you might say, how? Because remember, like, whenever, if it's a lease component, what we do is we recognize a lease liability immediately, right? So in this case, there is a non-lease component. If you recognize that as well, your lease liability will increase, right? So that will have a negative impact on our investors. So we try and not to include it within a single lease. Okay. So next thing that we need to also look at is reassessing the lease liability. So when will the lease liability be changed, right? So if the changes to lease payments occur, then the lease liability must be recalculated and its carrying amount adjusted. Similarly, a corresponding adjustment is posted against the carrying amount of right of use assets, right? So this might occur in case of variable lease payment. Okay. So basically your consumer price index will change, and then based on that your lease liability will change, and then at the year end you will need to do a corresponding entry as well. Okay. So in case of other things, if this case is not there, if it's not a variable, then what will happen is that basically lease liability should also be recalculated using revised discount rate if the lease term changes or the entity's assessment of an option to purchase the underlying asset changes. Okay, so if the lease term changes or the option to purchase of that particular asset changes. Okay. So the revised interest rate should be the interest rate implicit in the lease for the remaining of the lease term. If not, use borrowing rate. Okay, borrowing rate of from the market, right? So it's just general borrowing rate. So these are the three conditions in which you need to reassess the lease liability. Okay. So next thing that we also need to look at is basically short-term and low-value assets. So IFRS 16 particularly defines that it does not really give a numerical value of low-value assets, but it provides us something else. Okay, I'll tell you in a bit. So simplified treatment is allowed if the lease term or short term that is less than 12 month at the inception date. Okay, so for a short life assets which is less than 12 month or a low value assets, what we need to do is that the lessee can choose to recognize the lease payment in SOPL on a straight line basis. Okay, so no need to do a present value and all these things, right? So no need to recognize right of use assets or lease liability as well. So IFRS 16 does not particularly specify any monetary value of an asset that should be considered low value, but instead what it does is that it provides us examples. Okay, like four examples that are provided. It's basically computers, small personal computer, telephone, tablets, and small items of furniture. Okay, these are the four items that has been prescribed by IFRS 16. So whenever we are talking about value, right? So low value item, it should not be valued on the present value. Okay, so it should be valued based upon its value as a when it is new. Okay, so suppose if you are valuing a car, right, which has been driven for 25 years, so now its value is very low, right? So you might say that's a new low value item, but that's not it. You need to value it as if it when it is a new item that time. So based on that assessment, a car would not qualify as a low value asset, right? Because if it's a brand new car, it would be costing thousands of rupees, right? Or thousands of dollars, whatever currency you are in, right? So these things also need to be taken into account. Okay. Next thing is mid-year entry into lease. So based on this, what we need to basically adjust in case of mid-year lease is that, as you have done in case of group accounting as well, mid-year acquisitions, mid-year disposal as well, right? So what we need to do is that basically the depreciation amount will be different, the interest amount will be different, basically time apportionate, right? So if we entered into a lease in the middle of the year, then 6 by 12, and then for interest as well, 6 by 12, same thing, right? So it just depends. Okay, similarly, so in case of lessee, what do we need to disclose is that we need to first of all prepare basically the right of use assets should be presented separately on the face of, should not be presented separately, okay, on the SOFP. So it should be presented in the same line of assets as if it were owned by you, okay? So it's not like treating it as a separate, okay? So no discrimination, okay? So depreciation charged on the right of use assets, right? So depreciation every year we need to charge depreciation, right, on right of use assets. Remember, depreciation is always the shorter of useful life and the lease term, right? Next thing is interest expense always on lease liability, and then if the expenses relates to short-term leases and leases of low value items, okay, low value assets. So what are these expenses? We need to clearly mention it. So cash outflow for lease assets as well should be included. Similarly, right of use assets additions, so there might be extra more lease contracts that we have entered during the year, that should be included. And then the carrying amount of the right of use assets, the maturity analysis, this is a bit different thing in case of disclosure, is maturity analysis of lease liability, okay. Similarly, so lessor accounting, right? So in case of lessor accounting, IFRS still provides us the choice between finance lease and operating lease. We can classify it under these headings, but what we need to do is that, what is finance lease? So finance lease is where substantially all the risks and rewards of underlying asset transfer to the lessee, okay. So all the risks and rewards of the underlying asset is with the lessee, okay. In case of operating lease, what happens is that basically the risks and reward are not with the lessee, okay. So there is a very minor risks and reward, but not substantially, okay. Okay, so that does not help, right? So as you can see over here as well, that's too broad, right? So whenever we are classifying this thing, so what we need to do is that a lease is probably a finance lease if one or more of the following things apply. Okay, so what happens is basically if one or this more of this criteria is applied, then we will classify that as a finance lease. Okay, so if the ownership is transferred at the end of the period, or if the lease term is for the major part of the asset's economic life, right? And then the lessee has the option to purchase the asset for less than its expected fair value at the date the option become exercisable, and it is reasonably certain that the option will be exercised, right? So these are the three criteria. There is more as well, okay. So at the inception of the lease, the present value of the lease payment amounts to substantially all the fair value of the leased assets. Then if the lease assets is of specialized nature, right, without and then the lessor cannot utilize it without major modifications. So it might be in case of specialized factory and all, right. So and then the lessee will compensate the lessor for their losses if the lease is cancelled. So if there is a termination penalty, then that's a finance lease. Similarly, so if there is gains or losses from fluctuations in fair value of the residual fall to the lessee, which means that the risks of fair value decrease uh, in the residual asset, right, will lie with lessee, then it is considered as finance lease. So and then if the lessee can basically negotiate a contract again for a secondary period for a lower than the market rent payment, then also it is considered as finance lease. Okay, this is a bit unique point, but it's very important to remember this as well. So basically what do we have? The ownership is transferred. Next thing is option to purchase, right? So third thing is basically the lease term is for major part of the asset's economic life. Fourth thing is basically if the present value of lease payment is substantial to the fair value of the assets, if the asset is of specialized nature. Then after that, your sixth number point will be the lessee will compensate for their losses if there is a termination of the lease. Your seven number point will be if there is any gains or losses, and the risk is with the lessee for the residual value guarantee. Okay, that's your seven number, and then eight number is if the lessee can use the asset for a lower market price in the secondary period. Okay, then finance lease, how do we measure it? So initial measurement will be at the inception of the lease. The lessor presents asset held under finance lease as receivable, right? So that will be a receivable in the books of lessor. And then what will the value of receivable include is basically the lease liability that will be recorded by lessee will be the thing that will be recorded by the lessor. Okay, so as we had already discussed earlier, fixed payment, variable payment, right? And then your residual value guarantee amount of that, right? So options, and then your termination penalty. So all these things will be included within the receivable. So basically that will be the same amount which will be recognized in the balance sheet of lessee as well, right? So the amount will be basically same. Okay, you can tally it as well. So when you are doing the subsequent measurement, what we do is basically we do a finance income, and then so debit your receivable, credit your finance income. Okay, so that's what we will basically do, and then the carrying amount of the lease will be reduced, right? So the receivable amount will be reduced. I mean, so in case of lessee, what will happen is that the lease every lease payment will reduce the lease liability. In this case, the receivable amount will decrease, right? But by the same amount. So a bit different is with operating leases. Okay. So in case of operating leases, what we need to do is that is basically income from an operating lease is basically recognized over straight line, and then any direct cost of negotiating the assets are added to the cost of underlying asset. Okay, it is added to the cost of the asset, and then it is depreciated in accordance with IFRS 16 or IAS 38 intangible assets. So you might be leasing your franchises and all, right? So your rights and all, so that is under IAS 38. Okay, so these two apply. So whenever we are talking about disclosures regarding lessor, right? So what we need to be careful about is that so the right of use assets will be basically presented in SOFP as per their nature, as if it were owned, right? And then the profit or loss on sale. Okay, this is very important. So there might be some profit or loss that might be arising from the sale. This should be recognized as well. And finance income, changes in carrying amount of net investment in finance leases, maturity analysis of receivables. Okay, so for operating leases, what we need to be careful about is that so we need to do a maturity analysis of undiscounted. Okay, so maturity analysis of undiscounted. So operating leases are not discounted, that's why it is undiscounted over here. Okay, operating leases not discounted. So similarly, after the disclosure is done, main thing is sale and leaseback. So if it's a sale and if it's not a sale, how do we treat it? Okay. So a seller must apply IFRS 15 to decide whether a performance obligation has been satisfied or not. This normally occurs when the buyer obtains control of the asset. Okay. So if the buyer obtains the control of the asset, then it is a sell. Okay, so when do they basically obtain the control is that so they have the physical possession, they have the substantial risks and reward, and then basically they can prevent third party from obtaining the benefits, okay, and they will be the one enjoying the benefits, okay. That is main crucial thing over here, okay. So similarly, if the transfer is not a sale, right, so how do we do that? In simple words to say is basically it will be treated as a loan, okay, so as a financial liability. So since it is not a sale, that means why you are getting the money is basically you will be treating it as a loan as per IFRS 9. See over here, if the transfer is not a sale, it is recognized as a financial liability, right, equal to the transfer proceeds. The buyer, lessor will not recognize the transfer assets. So the person whoever is providing the transfer proceed will also not recognize an asset, okay, because it's not a sale. It does not satisfy the performance obligation as per IFRS 15, okay. So if it is a sale, what we need to do is that basically if it qualifies as a sale, then the seller must measure the right of use assets as the proportion if the previous carrying amount that relates to the rights retained, okay. So what we need to do is that basically based on your fair value, you will need to compute your lease liability will be your retained value, and then your fair value will be your total value of the assets, right? So how much rights is retained by us, that will be kept within our books, and how much rights we have sold will be basically uh, in his books, okay. So we will be recognizing a profit or loss on that transferred thing as well, okay. So how much ever assets we have transferred, we will be recognizing a profit or loss on that as well. But it's always good to remember that you will need to account for this as a proportion of the previous carrying amount that relates to rights retained, okay. So if the transaction is not at a fair value, then how do we treat it, right? So this is also another crucial thing that's which is not in FR book. So if it's below the market terms, then if the sales proceed is less than the asset's fair value, and then if it is above the fair value, then it is treated as additional financing. Okay, simple thing. Just have a go around it. It's pretty simple, right? So yeah, that's pretty much it in case of leases. So we had a brief discussion about lease, right? So if you have any questions regarding this particular IFRS standard, please do comment down below. I'll definitely be happy to answer it for you. And we will be looking at further problems, numerical problems as well, that will give us a lot of clarity, okay? So until next time, bye-bye.